Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Matt Markiewicz, Managing Director at Tuttle Capital, the sponsor behind the SPCX ETF, a recent transfer to Nasdaq, to discuss the SPAC environment for 2022. Matt, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me, Jill.
All right, let's review the SPAC market in 2021. We knew it was a banner year for deals. Give us some insight behind that.
Yeah, we saw over 600 SPAC IPOs last year, which was equivalent to almost $63 billion, $163 billion of new capital raised, which was a significant increase over 2020, which was about $83 billion. So we saw a doubling of issuance, and that $83 billion raised in 2020 was across 250 deals. So again, I don't think we'll ever see anything like it again, but certainly, as you said, a banner year for SPAC issuance.
And Matt, we know what SPACs are. Now I'm starting to hear more about de-SPACs. Explain to the audience what that is.
Sure. de-SPAC is a company that has consummated a merger with a special purpose acquisition company, and it is after the deal has closed. So the SPAC IPOs, they go and now they look for a merger partner. It gets announced, and then when it closes, the new company, the surviving company, starts trading under a new ticker symbol. So some of the more notable de-SPACs that we like to talk about are DraftKings, Virgin Galactic, WeWork, for instance, one of the more recent de-SPACs. And those are the companies, again, that survive after the merger with the SPAC.
What are you expecting for 2022 SPAC market, considering it does look a lot different than it did this time last year?
Yeah, I mean, we of course expect issuance to be much slower this year. Right now, we've seen 21 deals to date in 2022, a much slower pace than last year. We also have seen 7 sponsors cancel their IPOs. So they decided to not go ahead with the IPO for their SPACs. That compares to 11 cancellations last year. So we're not even a month done in January, and we've already seen 7 cancellations. So a lot of sponsors are rethinking their plans to go public with the SPAC at this time.
Matt, why could that be? Is it because the volatile market conditions that we've seen from the end of December 2021 up until January 2022, or is it because of the quality of companies that are looking to come public via a SPAC, a combination of both those reasons?
Yep. Well, first of all, right now there are almost 600 SPACs that are pre-deal, meaning they're looking for a merger partner, representing about $160 billion of capital. So there's a lot of supply out there, and there's a lot of competition for SPACs to find a merger partner. So that's the first thing. It's just the supply, I think, scares a lot of the sponsors that are thinking about coming to public. The real issue, though, is that the SPAC market has cooled off massively from last year at this time, mostly due to the SEC, rules around the guidance around accounting treatment of SPACs that helped to cool the SPAC market last year. SEC did what they intended to do, which was to help kind of calm that fervor that we saw for SPACs last year. Also, there, as I mentioned, there's just a lot of money floating around right now in pre-deal SPACs. So that competition is huge, and I think that scares a lot of the would-be, especially first-time SPAC sponsors,
right?
Not the serial sponsors necessarily.
So if you have, what is it, typically 18 to 24 months to put this capital to work, what happens if you can't find a partner to do this deal with? Does it just go back to the original investors? What happens to that money in the trust?
Yeah, that's part of the attribute around having a SPAC is that money gets redeemed by the shareholders. And we did have one liquidation last year, which I think a lot of investors thought that number would be higher. But that was very encouraging to me that we did see only one liquidation. So you are seeing, though, Jill, a trend in SPACs putting more in the trust. So typically a SPAC will have $10 cash in trust. Most of the SPAC deals that we've seen over the past, let's call it 4 to 6 months, have been overfunded trusts, meaning there's $10 or $10.20 in trust. So that is if you choose to redeem the SPAC shares, what you'll get back. So the SPACs IPO at 10 and you are getting $10.10 or $10.20 back on your redemption. That's a right that you have as a SPAC shareholder. So that is one of the trends that we've seen that's been really interesting, is that's how sponsors are attracting investors back into the structure by sweetening the deal, so to speak. And also you've also seeing a higher warrant coverage, meaning the warrants that are usually attached to SPACs. January, February last year, warrant coverage was declining because the sponsors felt they didn't need high warrant coverage. But now you're seeing a lot of SPACs come to market past 3-4 months, especially with half or 3/4 warrant coverage. And some of them even have a right in addition to a warrant coverage. So really sweet terms for the IPO investors. And again, anyone in investing public can participate in a SPAC.
Let's talk about SPCX. This is the SPAC New Issue ETF. Give us some of the characteristics, the methodology behind the portfolio.
Sure. It's the first actively managed SPAC-focused ETF. We launched it in December of 2020. And in the end, this is an event-driven strategy. And it's not necessarily meant to replicate the performance of a larger index or a broader equity exposure, if you will. And the reason why you would explore a strategy like this is that it has a very low correlation, especially to the broad equities market. I think over the last year we've had less than a 0.4 correlation to the Russell 2000, or that's the small cap index, even though SPACs by nature are small cap. From a size perspective, median SPAC is around $300 million. So again, like a small cap, but it really doesn't have much correlation to a small cap. So that's what we're really looking for here, is a strategy that doesn't trade like the S&P 500. And it also offers investors an opportunity to achieve bond-like returns given the nature of the SPAC. So one of the things that we do is try to avoid any de-SPACs in the portfolio. We do actually have 2 ETFs that do focus on de-SPACs, but for SPCX, it's a strategy that again focuses on the pre-deal SPACs, and we're looking to take advantage of dislocations in the prices of the SPACs before they actually announce a deal.
All right, Matt, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.